Assalamualaikum and good day. My name is Munawara. I will present about the introduction. We have choose two financial services for our fund project. The first one is OCBC Bank and the second is Kenanga Investment Bank Berhad. We have three objectives to achieve for our fund project. The first one, we want to compare the financial health based on the annual report on year 2023 and 2024 that we have found. Second, we want to analyze the risk and return for the both financial services on year 2024. And the last, we want to identify the strength and the weaknesses in the ratio analysis. Okay, for the purpose, we have three purpose for our foreign project. The first one is we want to provide the opportunity to apply a knowledge on the financial analysis and decision making. Second, to strengthen our ability to analyze the financial statement in the detail. Last, we want to deepen our understanding of the capital markets and share trading practices. And I will pass to the next presenter for the company profile.
OCBC, also known as Overseas Chinese Banking Corporation Limited, is a Singapore multinational banking and financial services through the merging of three banks in the economic crisis of the Great Depression. Founded on 31 October 1932 by Lee Kong Chian, and headquarters is located at South Bank of Singapore of the Bank Singapore River House. The mission of OCBC is to enable people and communities to realize their aspiration by providing innovative services to meet expectations and needs and are customer centered. Next is their vision. They are very committed to long-term value creation as they want to build long-lasting relationship and delivers the best outcome. They focus on four values, which is number one, integrity, to hold them into an ethical standard. Number two, forward-looking. They stay curious and to achieve the changes of trend and embrace the changes of trends. Third is respect. They respect shareholders, customers with empathy. Lastly is a responsibility. They take accountability of their actions and their decisions. As they only have three services, which is customer and retail banking, corporate and commercial banking, and lastly is Islamic banking. KIBB, also known as Kenanga Investment Bank Berhad, is the largest independent investment bank in Malaysia. At first, they are incorporated as KAN, Kenanga Asian Berhad. But now they changed to what we know now. Founded on 1973 by YM Tengku Dato Paduka Nur Zakia binti Tengku Ismail with her business partner Tuan Haji Kamaruddin bin Taha. Headquarters is located at Federal Territory in Kuala Lumpur. Their mission is to create new asset and wealth management experience for everyone, as their investors are committed to preserve and grow customers' wealth. They want to be the best leading investment bank. They want to aim to be the elite independent investment bank in Malaysia. Next is their vision. Their vision is to alter wealth management by removing barriers and promoting financial inclusion. They hold two values: agility and future facing. Their services include of equity broking, investment banking, treasury, Islamic banking, derivative investment management, wealth management, structured lending, and trade financing, with a strong foundation in regulatory compliance with the Sharia and their risk management.
They have two types of liquidity ratio. The first one is current ratio. Formula for current ratio is current asset divided by current liability. And the second type is quick ratio, which is current asset minus inventory divided by current liabilities. Okay, risk method on Kenanga Investment Bank Berhad, or we call it as KIPB. We have compare between 2 years, that 2023 and 2024. For the part current ratio, we can see that in 2023, current ratio KIBB is 1.11 times, and to 2024, the current ratio have been decreased to 1.10 times, which is they increase by 0.01 times, meaning that the company has a potential liquidity problems and difficulty on the meeting short-term obligation. And the second liquidity ratio is quick ratio. In KIBB, we can see on 2023, the quick ratio for KIBB is 0.46 and have been increased 0.04 times to 2024. There have been 0.50 times. Okay, meaning that the company can cover a short-term asset and have improvement in their liquidity. OCBC Bank, in the time series method, we can see that current ratio for both year is 1.11 times, and quick ratio for both year is 0.08 times. We can see that the current ratio and quick ratio remain constant, that have been showing that stable cash flow and good control over assets and debt. Cross-section method is compared between Kenanga Investment Bank Berhad KIBB with the OCBC Bank. We can see based on the table, current ratio for KIBB is 1.10 times and OCBC 1.11 times. OCBC actually has a much stronger ability to cover a short-term debts, and they also have the high current ratio, means the company can easily pay the debts. However, for the quick ratio, KIBB is 0.46 time and OCBC 0.08 times. From this, we can see that KIBB has much stronger liquidity and can handle the financial obligation than OCBC, which indicates that OCBC might have the potential risk in their liquidity.
Hi madam, my name is Tanya Rubini and I'm taking BIA. So I'll be explaining for activity ratio analysis. So here we look at the Kenanga in terms of fixed asset turnover. Kenanga was more efficient in both years, but the ratio is quite low for the banks. And for the receivable turnover, Kenanga was slightly better than 2023, but it became slower in 2024. For OCBC, it has improved and collected receivable faster. And also for the total asset turnover, OCBC has performed better for the both year. So this showing that OCBC has stronger efficiency in using asset to generate the profit. So for the average collection period, Kenanga was very slow in 2023 at more than 250 days. So although it has improved in 165 days in 2024, however, for the OCBC, it was much quicker, which is it collected in around 55 days and in 2023 and 52 days in 2024. So to summarize it, Kenanga is stronger in fixed asset usage, but OCBC is clearly more efficiency for the overall, so especially in receivable collection and also asset turnover. So over the 2 years, OCBC also has outperformed Kenanga in most in activity ratios. So that's all from me. So I will pass the next part to my next member.
So I'm going to talk about leverage ratio, which is consists of time interest earn ratio and debt ratio. So first we're going to talk about time interest earn ratio. In time interest earn ratio, we can see that KIBB shows negative value for both sides, as for OCBC shows a positive value for both sides. So their time interest ratio for KIBB, as it is in negative value, it can means that they have difficulty in paying their interest expense. As for OCBC, since it is in more on the positive value, it means that the company has more than enough income to pay their interest expense. Next is debt ratio. In the debt ratio, we can see that OCBC has higher debt ratio in 2023. It means that they relies on liabilities to finance their asset. As for KIBB, it is much lower compared to OCBC, meaning they are less dependent on using their debt. But by on 2024, the debt ratio for OCBC is a little bit stable as it decreased from 0.9018 to 0.9006. And as for KIBB, it shows a little bit of increase, meaning they have higher reliance on using their debt.
Hello, my name is Ayudania binti Ahmad and now I will be presenting the last ratio, which is the profitability ratios. So for KIBB Bank, the profitability improved significantly from 2023 to 2024. For operating profit margin jumped from 86.9% to 225.7%, showing a dramatic improvement in operating efficiency. For the net profit margin also rose from 28.3% to 35.7%, indicating stronger overall profitability. For return on equity increased from 7.1% to 9.2%, showing better returns to shareholders. Next, return on assets improved slightly from 1.2% to 1.4%, reflecting a modestly more efficient use of total asset. Finally, for gross profit margin, moved from 10.7% to 11.7%, showing small but positive growth. For other percentage, I'm just going to round up. So overall, for the KIBB Bank demonstrated major gains in operating efficiency and profitability between 2023 and 2024. So moving on to the profitability ratio for OCBC, we also see improvements across most measures through less dramatic compared to KIBB Bank company. So for operating profit margin increased from 92.6% to 96.4%, showing consistent operational strength. For net profit margin rose from 32.5% to 36.7%, reflecting stronger profit generation. For return on equity, grew from 11.6% to 12.9%, confirming steady shareholder returns. So for the return on asset, improved from 1.1% to 1.3%, signaling better asset utilization. So lastly, and for the gross profit margin, expanded from 47.9% to 52.7%, highlighting strong cost control and revenue efficiency. So for OCBC, they maintain solid profitability and achieved gradual improvement year on year. So for 2024, the gap narrowed in some areas. KIBB's operating profit margin surged to 225.7%, far surpassing OCBC's 96.4%. This is an exceptional improvement. However, OCBC still led in net profit margin at 36.7% versus KIBB's 35.7% and in return on equity 12.9% versus 9.2%. For return on asset, KIBB slightly outperformed again at 1.4% compared to OCBC's 1.3%. And in gross profit margin, OCBC maintained a very strong lead with 52.7%, well above KIBB's 11.7%.
Hello, my name is Nur Shafina, and I'm going to be presenting about the risk and return that we have calculated for both OCBC and for Kenanga Investment Bank, or shortly called KIP. So first and foremost, I'm going to talk about the expected return, which basically the expected return is about the profit or loss that an investor they can expect based on the past rate of returns. And in this case for OCBC, we see the data over here. It's about 0.11%, and for Kenanga we can also see that it's about 0.03%. And from the analysis that we have conducted, we can see that both companies they show a low average return, which basically means that for every $1 invested, they only get back about a fraction of each cent that they have invested, which means that it's not really attractive for investors to invest in both companies, especially if they are seeking high profits. Over here we can see the graph, and even though we can see that OCBC is higher than Kenanga, they both still have low average return. So on the other hand, when we look at the variance, we can see that the variance is basically like how dispersed the data set is. And we can see that OCBC, we have calculated to be 0.0000855, and for Kenanga we can see the data here to be about 0.0003486. Well, we can visualize it on the graph over there. And basically from what we have analyzed is that OCBC's variance is small, which overall means that the returns doesn't actually quite change too widely. But overall it shows that the company's financial performance is quite stable with low risk. But on the other hand, for KIP, it's quite high, like the variance is high, which indicates about an unstable performance. So getting returns is quite difficult, especially when we look at the mean. Moving on to standard deviation. Basically, the standard deviation sums up to about the risk or volatility, which is based on your investment returns. So the lower the standard deviation, the lower the risk, and the higher the standard deviation, the higher the risk. So in this case, you can see that the data that we've collected for OCBC is about 0.90%, and for Kenanga is about 1.87%. So we can see that Kenanga is higher than OCBC, and based on the analysis that we have conducted, which is also similar to variance, by the way, the smaller standard deviation, like what I said, it means a more stable return since it's associated with a low risk. But we can see that KIPS is basically almost as twice than OCBC, which means that when we compare both companies together, KIP has more a higher volatility, a higher risk compared to OCBC. And we can visualize it from the graph over here. And moving on to the coefficient of variation, otherwise I like to call it CV, it's basically to assess the risk per unit of return. From the data we have collected for OCBC, it's about 8.46, and for Kenanga it's 7.022 rounding off. And from the analysis that we have conducted based on both of this, as you can see that for Kenanga it's significantly higher than OCBC. And overall, higher CV, it basically means that investors are taking more risk for very little return, which does not sound good at all. So the CV for OCBC is quite high compared to the return. Meanwhile, for KIPS, it's way higher, which does not mean that it is good for investors overall. Like we have concluded from the overall report that we've conducted that both companies they're not really attractive options for investors because the risk-to-return trade-off is quite poor. We can see over here that if OCBC at 8.46 is already quite high, like means it's more risk for very little return, then we can definitely see that for Kenanga, which is about 70, is more than that. It means that risking more for very less return, which is not it's not attractive for investors.
From the ratio analysis, we can see that OCBC performed better when it comes to efficiency, profitability, and financial stability. As for KIBB, while it did show some potential, it still has challenges on their asset utilization, debt coverage, and margin sustainability. These financial ratios are to determine the company usage and the understanding of profit from the financial statement. The purpose of these ratios is to help future investors to easily evaluate the company performance and to compare them over the number of years. Overall, we can see that OCBC can perform better compared to KIBB.
So I'll be continue for the recommendation part. So for here, the recommendation for Kenanga, they need to improve their cash and quick access so they can pay bill more faster, and also they also should use their asset better and collect the money from the customer more quickly because it currently takes 165 days, and also they need to manage their debt carefully and make sure the cost and revenue are balanced to increase the profits. For OCBC, they are actually doing well. They should continue using their asset efficiently and keep making good profit as they can slightly improve cash reserve by watching their debts and also showing stable returns to attract the investors. So in summarize it, OCBC is more safer and better for the investment because they already have steady profit and they also have low risk for everything. However, for the Kenanga has potential to grow, but it has higher risk and need to fix the efficiency and their debt issues. Okay, that's all from me and thank you.
As a closure for this video, we want to share what we have learned throughout this final project. So through this project, our group gained valuable insights into both technical and practical aspects of financial analysis. We learned how to calculate and interpret important financial ratios such as profitability, liquidity, leverage, and activity ratios. And we applied this to real companies, which helped us understand how financial performance is evaluated in practice. Another important learning experience was working with risk and return analysis using share price data. This allowed us to see how expected return, variance, and standard deviation are connected to investment decision making, giving us a deeper appreciation of the trade off between risk and reward. Beyond technical knowledge, we also develop soft skills such as teamwork, problem solving, and communication. Preparing the report required collaboration and commitment, while the presentation helped us practice explaining financial concepts in a clear and professional way. Overall, this project has enhanced both our analytical